Hello students, welcome to my class. This is Professor Vincent Osaya and this is the presentation of part 2 of chapter 23, Statement of Cash Flows. We left off by talking about the classification of cash flows, and we said that there are three categories. Financing activities, we did talk about that. We said primarily those are activities relating to how a company raised funds to finance their company. So think about an individual or a company that decided to get into grocery business. So the company will issue common stock or stock for that matter and raise money, and also engage in some long-term liabilities vis-a-vis issuing bond or securing $1 million loan from the company. So all those are all cash inflows under financing activities. Now let's take a look at investing. So if a company wants to start a grocery business and the company has $2 million, what would they normally do to get the business started? They buy a piece of land, right? And they buy a big property, right? So when they engage in those kind of activities, we said that those are investing activities. So you need to invest those money in long-term assets. They will buy a truck to pick up the grocery, they buy building, machinery, so on and so forth. So those are investing activities. So the money that they spend will be cash outflows under investing activities. So by the time all those long-term assets are purchased to get the grocery company started, of course you have to go about the business of actually doing what you are set up for, which is buying and selling groceries. Now, those activities relating to buying and selling grocery, which is the main reason why you are in business, we call those what? Operating activities. And of course, as you know, operating activities are reported in the income statement. So almost every item on the income statement is an operating activity. So that is the overview in terms of the definition of these three categories. So moving along, let's take a look at this classification further. Now, like I said, on your examination, it is very important for you to know what is cash inflows and cash outflows under each category. So let's take a look at operating activities. Sales of goods or services. So if we sell goods and services to our customers and we receive cash, that would be cash inflows, obviously under operating activity, because that relates to the operation of the business. Now, if we buy inventory, pay employees, pay government taxes, those are all cash outflows under operating activity. Now, I want you to watch out for this. Couple of confusing issues here. Let's go back to financing activity. So, if you borrow $1 million from the bank and you receive the cash for $1 million, obviously that is cash inflow under financing. If you pay back the $1 million back in 5 years, that is cash outflows under financing. Now, this is where it gets tricky. When you pay the $1 million back in 5 years, every year you have to pay interest. The interest that you pay, even though it relates to the $1 million money that you borrow from the bank, that interest is interest expense and it's reported on the income statement. So that interest payment is what? Cash outflows under operating activity. That's kind of confusing. Now, so the long-term liabilities. Now, let's take a look at stockholders. So hold on to that thought. Investment. Listen to this very carefully. Sometimes a company can buy other companies' stock or bond. So if you buy $10 million bond from another company, you pay $10 million, that is cash outflows under investing, because you are investing in another company. McDonald's can buy bond or stock of Apple. Companies buy their own stocks and bonds. Why? For the same reason why you and I would buy those companies' stock and bond. So if a company buy other companies' stock, that is cash outflow under investing. So now let's take a look at bond. When they receive the money back that they invest in bond, that is cash inflows. When they buy it, it's cash outflow. Here's the tricky part. The interest that they receive from the company is reported in where? Is interest income. Is reported in the income statement, so it is an operating activity. Now, let's take a look at if they buy another company's stock for $5 million. That is cash outflows under investing. When they get the $5 million back, it's cash inflows under investing. But guess what? The dividend revenue that they receive is reported in the income statement, so that is part of what? Operating activity. So what have we established here? Number one, dividend revenue. That is the revenue that we receive from other corporations because we buy their stock. That is an operating activity. Interest revenue that we receive from other companies because we buy their bond or because we lend them money, that is also reported in the income statement because it is an operating activity. Let's take a look at financing. For financing, when we borrow money from the bank, what do we pay? We pay interest what? Expense. That is also what? Reported in the income statement, it is operating activity. Now, look at it. How about dividends that we pay to our shareholders? You need to count this. The dividends that we pay to our shareholders is not reported in the income statement because dividend is not an expense. Revenues, expenses, net income, right? Net income is closed out into what? Retained earnings. From retained earnings, you pay dividends to the owners. So dividend that we pay is never reported in the income statement. So dividend payment to our shareholders is not an operating activity. Rather, what is it? Clearly, it is a financing activity. So, dividend revenue, interest expense, they are all reported in the income statement. They are operating activity. Dividend payment is not reported in the income statement. Therefore, it is a financing activity. So let's take a look at what we have here. Now, it is also important. Take a look at what we have here. From returns on loans, interest, that means we receive interest from our debtors, or we receive dividends from companies that we invest in. So we call those dividend income or interest income. They are cash inflows under operating. And let's take a look at what we have here. To lenders for interest. So the interest expense that we pay is cash outflows and is reported in the income statement, so it is part of operating activity. The only exception is dividend payment. All right? It is part of financing activity. So let's take a look at what we have here. Investing. So that is operating. So investing. So let's take a look at some of the examples of cash inflows. Number one, sale of property, plant, and equipment. Sometimes you buy plant and equipment, as a company, you don't need them anymore. You decided to sell them. When you sell them, the cash you receive is cash inflows under investing. Sale of debt or equity securities of other entities. Remember, we buy stock or bond of other companies just to invest in them. By the time we are tired of those investments, we need our money back. That will be cash inflows under investing. Collection of principal on loans and other entities. I just talked about that. And let's take a look at cash outflows. When we purchase property, plant, and equipment, that is cash outflows under investing. When we purchase debt or equity security, what is debt and equity security? When we buy another company's bond, that is a debt equity. So that is cash outflows under investing. Or when we buy another company's stock, that is an equity security. That is cash outflows under investing. Or when we make loans to other entities. So financing, take a look at financing. When we sell equity security like stock, common stock, preferred stock, we receive cash. That is cash inflows under financing. When we issue debt like bond, that is cash inflows under financing. When we pay our stockholders dividends, that is cash outflow under financing. When we redeem long-term debt, in other words, when we pay off our debt or go back and buy our stock back, remember treasury stock, we talked about that, that is cash inflows under financing. So, moving along, first we recommend that when we talk about cash, we are talking about cash and cash equivalent. So what are cash equivalents? Remember that in your intermediate accounting one, we said that those are highly liquid investments that are both readily convertible to amounts of cash, or their maturity are so near that they present insignificant risk of changes in interest rates. So we consider those as cash equivalents. Company's product life cycle is not a big deal here. What they are simply saying with this diagram is the fact that for a product life cycle, initially, including in the introduction, you have to cough out a lot of cash in financing, and you really don't get too much cash at the beginning from operating and investing. But as time progresses, the situation reverses. So let's take a look at the format of statement of cash flows. There are two ways of preparing statement of cash flows. The two ways are, number one approach is direct method, and number two is indirect method. At the end of the day, take a look at what we are trying to accomplish here. Here we are just trying to figure out the cash inflows and the cash outflows under these three categories, all right? We have operating, we have investing, we have financing. What are we talking about here? How much cash did you receive under operating, cash inflows, cash outflows, inflows, outflows, under these three categories? That is basically the essence of what we are talking about here. So, we are going to report the inflows and outflows from these three categories in preparing the statement of cash flows. So that is the end of part 2 presentation of chapter 23.